Stocks swing up and down amid tariff uncertainties. Capital goods and energy eke out gains, while healthcare and FMCG drag. Midcaps fare better.
Arun Khurana, the Deputy CEO and Executive Director of Indices Bank, resigned yesterday, taking responsibility for the deviation in derivative accounting. This confirms the CNBC-TV18 news break, where we said that the revelation will lead to 3 senior exits.
KPIT Tech holds back from giving a guidance and expects a soft first half in FY26 and tariff uncertainties, but is confident of delivering 18 to 20% growth annually, sans externalities. Hexaware too sees growth perking up as the year progresses.
The RBI has announced a mega liquidity infusion of 1.25 trillion rupees via the open market bond purchases from the 6th to the 19th of May. Bond yields have declined 7 basis points to 6.33%, while NBFC and banking stocks have risen. Citi's economists say liquidity infusion may be intended for faster transmission of rate cuts.
I guess India would be one of the first trade deals we would sign, US Treasury Secretary Scott Bessent tells CNBC in an exclusive interview. He adds that the onus of reaching a trade agreement with US is on China.
Taking a bit of a cautious stance is the market ahead of some very, very important data points. You're watching Halftime Report live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Patakia. It's an absolute delight to welcome Ekta Batra back to the studios. Ekta, welcome back. It's great to have you back on the show.
Hi, Hormuz. Yes, it's absolutely wonderful to be back. And, you know, it's been 6 months of maternity leave, but it's been 6 months of market volatility as well. So it's been a roller coaster ride that I've been watching from the sidelines, and it's great to be back to tracking the markets live and giving our viewers the updates that they need. But for today, it seems as though things are stable. Broader markets are outperforming. If you look at it on a month-to-date basis, the mid-caps are up around 6% but year-to-date, yes, there's still some way to go.
They're taking a bit of a cautious approach, right? Because we've recovered significantly from the lows as well, from levels of around about 22,000, and now we have come to almost 24,300. But again, that Friday's high continues to remain the pain point for the market, and it is the index that is facing that trouble, right? 24,365 was the high that it made last Friday, and since then it has not managed to cross that. For the last 4 days, the index continues to remain in that 24,340, 360 range, making highs. Today we did cross that level, but again we've come off those highs, and geopolitical tensions are the ones that continue to hog the limelight, and as a result of which sentiments are slightly subdued. What's the sentiment which is not subdued though is in the defense space, and all of these defense names, be it Garden Reach, Masgao Dock, Data Patterns, Cochin Shipyard, continuing to gain from where they left off in yesterday's trading session. The defense index is up 4%, and all of these stocks, Masgao Dock now at the highest point of the day, 7.5% higher, Data Patterns 7%, and of course the others like Cochin Shipyard and Garden Reach too. And of course, what's keeping the Nifty afloat, Ekta, is Reliance Industries.
Yes, absolutely. As you can see, it's the best level that we've seen in 6 months for Reliance Industries at this point in time. So that stock is higher. That's Reliance for you. That's currently up around 2.5% at around 1,400 odd rupees. But separately, we do have a lot of these IT stocks which are buzzing around today. So Tech M is up around 1.6%. LTI Mindtree is up around 1.5% at this point in time. We have bigger stocks such as Lastnet 2Pro also, which are doing well today. So up around 0.7% currently for L&T. On the downside, you'd have to say there's some pressure coming in a couple of these pharmaceutical stocks. So Dr. Reddy's, for example, is down around 2%. It's the top loser on the Nifty. In fact, it's had quite a terrible year. It's down around 15% on a year-to-date basis. Ultratech Cement post the conference call takeaways is a bit subdued, so that stock is down around 2% at this point. So overall, you'd have to say it's more about the broader markets. It's more about the mid-caps at this point, with the mid-cap index up around 0.3%. Advanced decline ratio currently just about even keel. But we'll take a short break on that note. As we do that, here's a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now and submit your entry for the SME Champion Awards Season 2. Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Let's get to the first stock that we're talking about today. In fact, RPG Life Sciences is doing quite well. That stock is up around 4 to 5 odd percent. It's cooled off to a gain of around 2 odd percent, but it had a solid start with an 8% increase at one point in time on an intraday basis. To talk more about the company, which showed a year-on-year growth but was a bit sluggish sequentially, we have with us Yuko Bank, who's the MD at the company, joining in now. Mr. Sikri, thanks very much for joining in. If you could just start by talking a little bit about the margin pressure that you've seen Q on Q. I agree that you've seen, an increase on a year-on-year basis, but if you look at your numbers on a sequential basis, there's been a little bit of a sluggishness. Take us through the reason for that. Is there a seasonality element here?
Thank you so much, Ekta, for getting me on your channel. I think you yourself answered. Actually, that is precisely the answer. The quarter four, for us as well as generally in the industry, is much lower than quarter one, quarter two, quarter three. This is what you would see in the last many years, 3, 4, 5 years. And I think it is simply that. Else, on YOY basis, quarter, annual, I think the numbers are on upward trajectory.
Mr. Sikri, good afternoon. Thank you for joining in. So what does this do to your projections? Because for the full year in FY25, you came up with margins of 24.5. So would you expect the number to be as is for FY26 as well? You've earlier maintained that you want to have your margins somewhere around that 26-27% range. Do we see that number going back to that level in FY26?
Yeah, my answer to this question had been very consistent. The upward EBITDA margin trajectory, which we have had in RPG Life Sciences, has been very structural. And it is not happening just 1 year, 2 years. It has been happening for the last 6 years. If I just give you the dimension, it was 10.4, it has moved to 26.4, not even a single year blip, recording about 1,600 basis points increase. And similar reflections are in PBT, 1,840 basis points increase, PAT, 1,380 basis points increase. Therefore, the upward trajectory which has happened is a function of strong cost optimization measures, both at cost of goods level as well as at the OPEX level. And those measures being structural continue, and therefore I don't expect the margin trajectory to be any way different than what we are seeing so far. Of course, the kind of the curve which has been, the slope of the curve has been, will be a slightly flattish, but the structural measures will continue to drive the EBITDA margin.
Okay. All right. So give us a ballpark guidance that you have for the next fiscal in terms of margins.
Yeah, Ekta, you know that we generally don't give the guidance going forward. I just indicate that the past is the proof. Upward trajectory will continue. We are, of course, pursuing 1,000 crore turnover going forward. That's the most logical next step. And with the improvement in revenue, I think the margin should also improve. At this stage, I must share with you that we have 3 business segments in our company. One is domestic, second is international formulation, and third is the API. We had so far the domestic formulation driving the growth. The international formulations and API, we have taken now 2 solid measures. One is the plant infrastructure modernization, make it approvable by the regulators. In fact, we have got the approval of the TGA and PMDA already for the API plant. And similarly, for the formulation plant, modernization has helped us to get the EU approvals. And we have invested close to 140 crore in the 2 plants. Now, with the 3 segments, all domestic formulation, international formulation, API, all the 3 firing, vis-a-vis only domestic formulation firing, I think revenue must accelerate.
Sure.
And the margin should also show the impact in margins.
So, Mr. Sikri, if you could share a breakup of your 3 segments. Now you mentioned that you are focused domestically, but now with all your 3 engines firing, as you just said, What does that do to your mix? How will the revenue distribution be among the three segments?
Yeah. We have currently 66% coming from the domestic formulation, 20% coming from the international formulation, and the remaining coming from the API. Now, as we go along, the domestic formulation will continue to grow ahead of the market, which has been happening consistently for the last 6 years. International formulation will start contributing more than what it has been contributing today. So therefore, the contribution of the international formulation business is expected to grow better than what it was earlier. And the API also should grow because of the measures which you have taken. As I described, we have modernized the plant, we've got the approvals, we have got the R&D pipeline also under development. Somewhere in late FY26, we should see the new products also coming out in the market. Currently, they are in the various stages of the development. That will add to the margin, the sales improvement and the margin improvement. Plus, I also want to point out to you that we were in debt. We have paid the debt. We have spent 140 crore in modernization of the plant. Today, we are sitting on a healthy cash surplus, which has further got increased. You would have seen the cash surplus is currently 266 crore. And with this, we are actively pursuing the acquisition inorganic opportunity, and that, depending upon the inorganic opportunity, the contribution of three business segments would finally pan out.
So that's exactly what we wanted to narrow down on, Mr. Sikri. This particular acquisition that you're looking at, you have 266 crores of cash. Can you tell us how much of it do you want to deploy in terms of an acquisition, and which segment are you looking at, domestic, API, or the international space?
Yeah, I think again, important question for us. We are now open to both API and formulation, because we see very strong growth trajectory in both formulations and API. So we are actively scouting the M&A opportunities. As I mentioned earlier, we have actually evaluated, I personally evaluated close to 25 such proposals. But the valuations being crazy, we have not been able to finally succeed. But I think we have now expanded our target from formulations to API as well. And therefore, that should help us to deploy the cash surplus we have generated ourselves. And plus, we have put on the leverage possible. That also gives us the opportunity to target bigger targets.
Right. Thank you, Mr. Sikri, for sparing time and joining us today. Wish you good luck for the rest of the year as well. That is the management of RPG Life. Moving on then, Max Healthcare has formally inaugurated its super specialty hospital in Dwarka, which will have a capacity of 300 beds. And our colleague Parikshit caught up with Max Healthcare CMD Abhay Soy and began by asking about this facility and their expansion plans. Listen in.
With this bed capacity expansion of 300 beds at present, we will be touching 5,100 beds across the country. This is our 25th year for Max Healthcare, and we've decided to celebrate it with 4 commissionings this year. First of which was yesterday was the Max Dwarka Hospital. And we look forward to the 3 other commissionings which are on our way. One will be at Max Saket, which is right in the center heart of our hub, which is in Delhi. Another is going to be in Nanavati, Mumbai, where we're expanding later in the year, as well as Mohali, Punjab. So exciting year for us. We are increasing capacity by close to 30%.
Right. As you said, this is your 25th year. Could you also outline some other growth plans for us, your own vision for the company over the next 5 years?
So I think there is a tremendous amount of asset creation which is required. As our country is sort of progressing, we are going towards being a $5 trillion economy. The aspirations of people, the desire for quality healthcare on one side is increasing. On the other hand, the population, the baby boomer population is becoming a year older, is likely to be a little more sicker as years go along. And we require quality healthcare. So I think really for us, it is, we are focusing on building quality healthcare assets. We have added 30% capacity last year, largely through acquisitions, but in the current year, we're expanding it by another 30%. and getting to 5,100. And, by the end of 2028, we should have another 3,000, close to 3,000 beds established. And this is what we're constructing at present. So, we should be close to 8,000 beds. And, the idea is really to keep reinvesting the capital that we are generating in order to create the quality healthcare assets that are so required in the country.
Right. I would also like to ask you about your capex plans. Last year in November, you had announced, you had said that you would be investing about 6,000 crores over the next 3 to 4 years. Could you give us the capex plans, the expansion plans for FY26 and overall till 2028?
So like I mentioned, we will be adding 30% more capacity, which is close to about 1,500 beds in the current year itself. Up till 2028, it was going to be another close to 2,000 beds. So that makes it about 3,500 beds total. This will be at a cost of about 6 to 6,500 crores and almost entirely through internal accruals. We will be at the same time be focusing on inorganic growth through acquisitions as well. I mean, we have a very low amount of gearing in our balance sheet of about 0.5 or 0.6 times debt to EBITDA. So that gives us enough headroom to acquire as well as build more.
Right. Are there more acquisitions, strategic acquisitions on the cards for this year?
Absolutely, and we're looking forward to some.
Okay. And could you give us a sense of the kind of cities where you would like to acquire such hospitals?
So we've been very clear about two things, that we have two requirements. One is we don't like to go into uncharted territories. We prefer territories where at least one or two of our peers have proven viability over a period of time. So these become uncharted territories for us. And the second is we seek a 20 to 25% ROCE over a period of time. We are currently operating at ROCE of about 35, 36%. We seek a ROCE of about 20 to 25%. So long as any acquisition or a new build, both these conditions suffice, we're happy to sort of go in there.
Right. Also, if we were to ask you about where is the highest growth for Max Healthcare coming from at this juncture and for FY26, could you give us a sense of the geographies, the cities which would be contributing to the highest growth?
We have a massive amount of capacity in metro cities, about more than 80% of our total capacity is in metros, but we are seeing significant growth in non-metros as well. Places that we've recently done acquisitions such as Lucknow, Nagpur. We've seen almost a 4x increase in our profitability over there. Some amount of it may be to do with the latent demand and the cities being underserviced, but another part is perhaps to do with the efficiencies that we've been able to sort of lend to these assets.
Okay. If we were also to ask you about other healthcare segments, you're of course talking about the bed capacity expansion, the strategic acquisitions in the hospital sector, but within healthcare, in terms of digital delivery of services, digitization, more digital apps, increasing your digital offerings. Are there some plans on the cards in terms of focusing on other segments in healthcare?
So we already have the digital app part aids our delivery system, and sort of services and supports us, our present patients. And, we've had that app now close to 24 to 25% of our total business is through digital sources. What I mean is you don't deliver healthcare through it, but your bookings and so on and so forth are done through digital sources. So, the world is moving towards that. Secondly, I think there are other very exciting verticals as well in terms of home care. That's a business which we have the largest sort of home care business in the country, perhaps the only profitable one. It's been growing at 25% CAGR. Our diagnostic business, again, has been growing at a 25% CAGR for many years, although it's a small percentage of our total overall revenues, but we see a lot of excitement in both these sort of verticals as well.
Right. Mr. Soy, we have been reading reports how almost 600 private hospitals, according to the IMA, have stopped treating patients under the Ayushman Bharat Health Insurance Scheme. We also see that many private hospitals have not yet come on board with the scheme. Could you give us a sense of what are some of the issues or hurdles that you see with the scheme right now and how it could be made better?
I think, with respect to private hospitals, particularly in the larger cities, the cost of, in metros, our cost of, manpower, our cost of fuel, our cost of land resources, and so on and so forth, are significantly higher than non-metro cities. So it's not necessarily viable for players like us to sort of participate in Ayushman Bharat from that standpoint. But I think, we have been working with the government how to sort of come up with more features in the policy, perhaps, which would be, then we will be able to accommodate those.
Right. Could you give us a sense of the features some suggestions that you've made?
I think one is to do with pricing. Second is to do with, our ability to use certain medicines versus, more generic medicines versus branded medicines and so on and so forth. So you'll have to reverse engineer the costs because I think effectively what is happening, the cost structure doesn't sort of work out for even from a standpoint of any contribution towards fixed costs. We are unable to cover variable costs. So that's where the problem lies.
Okay, so that's the management of Max Healthcare talking about their new hospital that they've opened in Dwarka and separately providing guidance with regards to how they are seeing growth pan out in a lot of their verticals. We'll take a short break on that note, but Sachidanand Uttikar of Trade Bulls will join in with some trading strategies. Stay tuned. Welcome back. Well, a couple of stocks are buzzing around. So Prestige Estates is up around 4.5%. We have India Mart, Yuko Bank, Popular Vehicles, Northern Arc. A lot of these stocks which are showing good traction, anywhere between 3 to 4.5% at this point. But let's talk about the technicals now. We have Sachidanand Uttikar of Trade Bulls joining in to discuss what he's tracking on the markets today. Sachidanand, hi, welcome to the show. Well, if you could start by giving us a sense in terms of the overall strategy, considering that the Nifty is just about consolidating at this point.
Good afternoon, Ekta. I think the market is consolidating well. In fact, it has been holding above its 5-day exponential moving average support for the last 11 trading sessions. And if you look at the constituents, today, despite of the consolidation, a stock like Reliance is already making, fresh highs. If you look at the overall structure, I think from a momentum perspective, we may see Nifty, again, showing that momentum once we see a breakout about that 24,450 mark. But as of now, I think the structure is a bit consolidative for the day. It's a good time wherein some long positions should be considered, especially if you look at the Nifty Bank, movement. We have seen some profit booking there, but even here, it has been holding above its 5-day exponential moving average support very well. So I think it's a good opportunity to deploy some long positions when it comes to Nifty Bank. The reward to risk opportunity looks better than Nifty. As of now, we don't expect the Nifty Bank to display a closing below that 55,000 mark. So this particular pullback towards 55,100, 200 is a good opportunity wherein some fresh long positions can be considered. One can keep a stop loss at 55,080 on a closing basis. Eventually, we are seeing a probable target close to around 57,265 on the weekly scale. So we are expecting that the markets may, again, see some momentum in the days forward. But as of now, today is a day of consolidation and where some long positions can be considered. The setup is more, fruitful when it comes to Nifty Bank, wherein some long positions can be deployed at this particular level itself.
Sachitanand, good afternoon. Thank you for joining in. Before I ask you about specific stocks, what are your recommendations for the afternoon?
Good afternoon, Harmos. Clearly, I think the structure of ICICI Bank has been very clear. It is a bullish flag formation. Today we have seen some profit booking, but the pullback is, looks very healthy. As of now, we are expecting that this particular rally in ICICI Bank should continue towards 1485 on a positional perspective. So keeping a stop loss at 1418, one can still deploy fresh long positions in ICICI Bank for a positional target of around 1485. The other stock on our radar is Voltas. Now, if you look at the overall sequence, it has been correcting, and we have seen a strong base somewhere close to around 1240, 1250 kind of a zone. We are expecting this particular double bottom, formation on the daily scale, and we may see a quick move towards 1360 going forward. Hence, we are recommending, building long positions in Voltas. One can keep a stop loss somewhere close to around 1245 on a closing basis. Eventually, we see this particular move getting unfolded towards 1360.
All right, Sachitanand, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. By the way, Reliance Industries is now continuing to keep the Nifty afloat as of now, 2.5% higher at the highest point of the day. Take a short break. The management of Yuko Bank joins us on the other side to discuss the road ahead and the quarter gone by. Stay tuned. Welcome back. Yuko Bank is the next management that's joining us on the show now. After a good fourth quarter, deposits were healthy. The asset quality also improved on a sequential basis. To discuss this and more, we are being joined by Ashwini Kumar, the MD and CEO at Yuko Bank. Mr. Kumar, good afternoon. Thank you for joining in. Your deposit momentum was fairly healthy during the fourth quarter. Advances were also up almost 18% from last year. Does this momentum sustain going into FY26? What are the targets that you have set in terms of both loan growth and deposit growth for the new financial year?
Thank you for having me on your show. If you see our performance during this current last financial year vis-a-vis the previous financial year, our deposit growth was around 5.5%. This financial year, our deposit growth is 11.5%. So we have already started building the momentum on the deposit front. There were two reasons previous year, and that deposit growth was not so good because we were not concentrating on deposit because our CD ratio was very low. So we had targeted a CD ratio of 74 to 75% in this financial year, which we achieved with a deposit growth of 11.6%. Now going forward, we have kept a deposit growth guidance of 10 to 12% and CD ratio to 75 to 77%. Along with that, the credit growth during the last financial year was around 17%. We will continue the momentum which we have built in this last financial year. If you see my credit growth, that was spread across segments. You take RAM, within RAM, retail grew at around 35%, MSME grew at around 18%, and agriculture grew at around 20%. So the momentum has been built within the entire banking system of the branch network. We have also implemented retail hubs and MSME hubs last financial year. So I believe that the momentum will continue in this financial year as well.
Okay, when you say the momentum will continue, any kind of specific guidance that we can expect when it comes to credit and deposit growth going into the entire fiscal?
See, this year we have, last year we achieved around 11.5%. So our guidance for the current year is 10 to 12% of deposit growth and 12 to 14% of our credit growth. That is the conservative guidance we have kept for ourselves. And given an opportunity where we have a bankable proposals and where our margins or our pricing is matched, we'll take further exposures as well. So on a conservative basis, 12 to 14% is our guidance.
What about asset quality, Mr. Kumar? It's improved on a sequential basis. Your gross NPAs are trending downwards. Slippages were marginally higher compared to the previous quarter. What would you attribute that to? And will the slippages number trend down as well as the quarters go by?
If you look at the slippages on an annual basis, our slippage ratio in the last 22-23 was 1.75%. Next year, we brought it down to 1.2%. This year, our slippage ratio is on a yearly basis is 0.92%. Our guidance for the slippage ratio is 1 to 1.25 in the current financial year. Absolute number may look a little higher, but if you look at the base, because the base has also increased now. So absolute number, but on a percentage terms, it will trend in the same range. Our guidance is 1 to 1.25%. So far as the gross NPA and net NPA, will continue our journey to bring them further down by concentrating more on recovery and containing slippages in the current quarter and the remaining quarters of the current financial year.
Okay, all right. Let's just get a little bit of color on the net interest margins. Can you just give us a sense in terms of what the cost of funds were this quarter? What are you guiding for going into the fiscal?
See, if you look at my net interest margin, last year net interest margin was in the range of 2.9 to 2.92, and we have given a guidance of net interest margin of 3 to 3.10. And if you look at the net interest margin, it is in this range only 3.09%. So, with the reduction in the repo rate, there will be some impact on the net interest margin. And going forward, I believe that the team is working on raising deposit, containing cost of deposit, improving CASA, because we have already launched many new products to converse new quality CASA customers account. I believe that we should be in the range of 3 to 3.1 also in this current financial year.
So 3 to 3.1% in the current financial year as well, Mr. Kumar. But there is so much competition, right? Almost all of your peers are vying for deposits. And so what are the steps that you are taking to boost your deposit growth and to lure customers towards your bank?
See, there are 3-4 things we have done in the last financial year for the first time in our bank. First, we started with the resource vertical at the head office level and zonal resource team at the ground level at zonal offices level. 43 zones we have across the country. Now, to strengthen the zonal structure, we are opening 6 more zonal offices and 6 more ZRT teams will be there. Second, we have done the tap banking. Earlier, it was we started last year with the 500 branches, then 700. Now, in March quarter, we have given tap to all the branches across the country. And now our entire branch network, our people, our staff can go to the office, to the workplace, to the home with the tap to open quality CASA customers account. So third thing we have done is we have revamped the entire product structure. We have now products for each walk of life. For a student, catch them young is our tagline for a student. And then we have for the female, we have a pink basket we have launched with additional benefits for the female customers. And then for salaried customers, we have a Suvidha salary product where we have for different salary structure, different combination of offers. And then for the normal customers which are not covered under these categories, there also we have revamped our product. Plus we have launched special deposit scheme also, plus green deposit scheme also. So a lot of effort is going on within the bank to see that we continue our march towards garnering the good deposits.
Okay. Just before we wrap up, you did speak briefly about the asset quality, but Mr. Kumar, just wanted to get a sense that, you know, your slippages were around 588 crores this quarter. What is the quarterly run rate that we can expect, and what is your guidance on recoveries as well?
See, our slippage during the quarter was 488 crore, not 588 crore. It is 488 crore. And slippages should be in this range only in this coming quarters. And overall slippage ratio, we have kept that in 1 to 1.25. And last year also, overall, our slippage ratio on a yearly basis is 0.92 only. So we'll continue to monitor our profile products, revamp those products also in the times to come. So the guidance for the slippage is 1 to 1.25 only. Second thing, on recovery front, we have already done around more than 4,000 crore of recovery in the last financial year. We have given a guidance of around 3,000 crore of recovery. And in December, since there were certain additional recoveries had come, we have revised our guidance to 3,250 crore. We surpassed that guidance also because there was one particular account which we was expected to get resolved in June quarter.
Right.
It got in the last quarter itself. So last year our recovery was much more than the guidance. This
Right.
year we have kept a guidance of 2,700.
One final question, Mr. Kumar, very quickly. You've raised 2,000 crore rupees through this QIP. Now, is there any further mandate to bring has the government communicated to you any further to bring the stake down? Because it's still at 90%, right? So to bring it down to 75%, has there been a timeline shared?
See, we have taken a board approval for capital raising plan in our board, and we will be taking up this for this approval to the AGM, the next AGM which we will be conducting, and then we will approach the government for their approval, for giving us approval to raise the equity through QIP in this current financial.
All right, Mr. Kumar, thank you so much for sparing time and joining us today, and wish you good luck for the new financial year as well. The management of Yuko Bank, the stock consistent at around 4% higher at around 32 rupees. Take a short break, but before we do that, here's some good news. Network 18 is the leader in the news information category on the platform leadership network level with 183.2 million unique views, beating Times Internet as per ComScore MMX report of March 2025 at the Social Plus on platform leadership network level. Network 18 is the runaway leader as per the Social Plus MMX ComScore report for March 2025 with 315 million unique views, which is 55% higher than the nearest competitor Times Internet at 202 million. News 18 also races ahead of the Times of India in terms of Social Plus MMX cumulative reach. News18.com overall clocked 251 million unique views to beat the Times of India overall with 183 million unique views as per the ComScore report for March of 2025. Now, as per the ComScore social media matrix report, Network 18 is 2 times bigger than the nearest competitor with a 54% reach within the 389 million overall social population. And speaking about Indian languages, in terms of Social Plus MMX cumulative reach, News 18 Indian languages is the leader in the category with 182 million unique views as per the ComScore report for March of 2025.
Welcome back. Well, let's get to another story now. Sources tell CNBC-TV18 that Sebi is looking into the veracity of disclosures made by Ola Electric. Yash is here with more details on this. Yash.
That's correct. So what we've been given to understand from our sources is that market regulator Sebi is looking into the veracity of disclosures made by Ola Electric. Now, Sebi's move of actually looking at the disclosures made by the company is particularly with respect to the instance of the February 28th disclosure, where Ola Electric had spoken about sales of 25,000 units, the monthly sales for February 2025, as against the government portal, which showed only 8,600 registrations. Now, Ola, of course, had sort of replied or clarified on that alleged discrepancy, saying that it's a straightforward case of a temporary registration backlog, and they are working towards streamlining this or sorting this out. Market regulator Sebi wants to see if there was more to it than just that. Why was there a discrepancy in the two numbers? Sebi is also looking at the stock price movement which came about on the day the disclosure, the initial disclosure was made, which is February 28th, about the two numbers. And of course, when the company clarified as the reason behind this particular discrepancy, Sebi is looking at the stock price movement on that day, and particularly looking into the fact that if investors of the company were shortchanged because of this alleged wrongful disclosure. Not just that, what I've also been given to understand from my sources is that Sebi is also looking at the previous disclosures, all the previous disclosures made by Ola Electric on the exchanges, and cross-verifying them with the actual data that arrived much later to find out if there was any instances of possible discrepancy before as well. Of course, this is Sebi's process which they've initiated against Ola Electric. We've written to the company Ola Electric on this one, but we're yet to receive a reply from the company.
All right, Yash, thank you so much for that exclusive details on Ola Electric. The stock now trading below 50 rupees. Take a short break. On the other side, Manisha Gupta joins in with Kunal Shah, the head of commodities and currencies at Nirmal Bang. Stay tuned. We'll be right back. Welcome back. Flat as flat can be for the Nifty, still at that 24,350 mark, continuing to swing between the gains and the losses. By the way, Garden Reach Shipbuilders is now up 13%, and all of these defense stocks are continuing to build on to their gains from yesterday. It's 13% higher for Garden Reach, 11.5% higher for Data Patterns, 10% higher now for Cochin Shipyard, and 8% higher for Mazgaon Dock as well. Of course, not to take away Hindustan Aeronautics, that's up 5%. BEL is up another 5%. BEML is up 4%. Bharat Dynamics too, trading with gains of 4%. So it is defense stocks across the board that are leading the gains in the broader markets. Over to Manisha Gupta now for Commodity Corner.
Well, thank you so much for that. And I have a guest with me, Kunal Shah, Head of Commodities and Currencies Research at Nirmal Bang, now joins us. Kunal, hi. A day prior to Akshaya Tritiya, and we've seen some profit taking continuing when it comes to gold and silver both. What would you, advise investors to do on this day now?
So as far as the next move by US and China, nobody knows what's going to happen. But I just get a feeler that somewhere, maybe in 10 days, I don't know the timing, but I'm pretty hopeful that there is likely to be at least talk between US and China regarding the tariff negotiations, because US has been talking to India, US has been talking to all the countries. So I think that should happen. It's just a matter of time. And I think we have seen the peak. Gold prices have made the high $3,500, whatever we have seen. Seems in a short term, I don't expect gold prices to go above that. And either it is going to consolidate or it is likely to go down gradually, because the demand side has been weakening. And we have not seen central bank buying gold at these levels aggressively. So I am of the view that the upside is very limited. In a near term, sell gold on rallies. It is likely to test 91,000, 90,000 on Indian bourses. And I'm not very optimistic in near term as far as the outlook of gold is concerned.
By the end of this year, though, Kunal, where do you see prices closing?
So nobody knows what's going to happen as far as the US economy is slowing down, but I believe at $3,500, everything is priced in. Okay, so I have been maintaining this view from last one and a half month, and I continue to have that same view. I think all the positive because of which gold prices should have been going up is already discounted in the prices. So you consider the rate cuts, you consider the US-China tariff situation, everything is in the price. So if there is a rate cut, there will be a bounce and again it will go down. So $3,500 for me this year is top. It can go up to again 3450, 3480, but I'm not expecting any fireworks until there is a major black swan event taking place in the world. Otherwise, the upside is very limited. We are not going to make money in going long in next 6 months. So not very optimistic.
And how would you look at silver then? Would you start looking at that one? Because the gold-silver ratio seems supporting of silver. And if you are bullish on base metals, then silver perhaps fits that bill.
Yeah, so this is the 5th year of deficit. We've seen our Silver Institute coming up with this forecast a couple of days back. So 5th consecutive year of deficit in silver. That's put a very strong case for silver to move up in next 6 to 8 months. The only reason right now silver is not able to shoot up is because in a near term, the Chinese demand seems to be in a doldrums because of this tariff. So China is taking a hit on the demand because of the ongoing tariff war between US and China. Nobody is able to figure out how much loss of demand is expected if this tariff war continues. So if there is a moderation in US and China's trade war, I think silver will shoot up immediately. So the downside is very limited considering the deficit, 5th consecutive year of deficit. $30 seems to be the bottom to me. And 93,000 on India, good buying levels. It is poised to test 1,05,000, 1,10,000 on MCX and $37 to $38 on COMEX by the end of the year. So the gold-silver ratio, which is right now trading at 101, roughly around 101, it should go back gradually towards 90. So I'm pretty optimistic on the outlook of silver.
Kunal, what is your sense also on metals? Because in the day-to-day, we're looking at some pressure continuing in case of copper. Also, when you look at the month of April, we seem to be closing this month in the negative. Are these levels good to buy yet again?
So in case of base metals, I'm quietly optimistic because Chinese government has already made a statement that in an event where the metal prices goes down, China State Reserve Bureau will be the buyer in that. So instead of buying gold or silver, why not buy copper? So the copper is the metals which is going to do very well in next 5 to 10 years period. So if that is the case, then if the prices are going down, it is really a great strategic move to add it into your strategic reserve. So that is one reason. Second is, if the tariff war continues for a longer period of time, then China is expected to come up with some or the other measures which will lead to like stimulus package or the rate cuts, which will support the domestic industry, which will support the mining industry over there. So that is also likely to be positive. And if there is a solution if there is a way out in China-US trade war, then I think obviously metal will go up. So I'm pretty optimistic about the outlook on metals, even though the Chinese growth outlook have been downgraded by World Bank and IMF. But I'm of the view that the downside is very limited. 840, 835 again levels to do bargain hunting in copper, and copper can move up to 870, 880.
Kunal, a final word on the crude oil prices, because after 2% of decline in the overnight markets, it's not anything else that the crude seems to be doing right now. It seems under pressure right now, especially ahead of the OPEC and allies production increase and also their meeting on 5th of May.
Yeah, so you must have the major thing to watch out for is how much oil US is adding in their strategic petroleum reserve at this point. Because we've already seen announcement coming from US that at these levels, they want to store as much as they can to fill up their strategic reserve. So now below $60, the profitability of a lot of shale oil players in US will again start to deplete. So I believe that any commodity going below its cost of production is an alarm for the producers, and producers eventually may act. So it can go down below 60 and stay there for a while, but eventually it just pulls back. So oil from here, it much depends on the top two economies of the world, the way they are fighting right now. If there is any positive talks, I think oil will shoot up. So if you are optimistic about the outcome of US and China talk may take place and there may be some positive outcome, then I think this is the great level to buy oil, because we are talking about both these economies having downgraded by World Bank. Suddenly, if there is a talk, it will all demand side scenario outlook will change. So at $60, nothing to lose in WTI. I will start to recommend to go long in oil, slightly for the positional point of view. And I'm expecting, at these levels, oil prices should stabilize and should not crash from here. And not expecting a big upside, but 8 to 10% upside can be possible in next 2 months, 3 months time.
All right, Kunal, thank you so much for sparing time and joining us today with your views. Manisha, thank you for joining in as well. With that, we call time on this edition of Halftime Report. We leave you with the Nifty above the 24,350 mark, closing in on Friday's high. Business lunch for the next 30 minutes.